Hi there, John Hardy here with the FX update for February 1st, 2011. My goodness, what a day. We have the bulls out here really teaching the bears a lesson if we look at equity markets, if we look at risk across the board. Let's start with the oil market. We're seeing it come off a little bit from the highs today, almost a buck here on the Brent crude contract from March, but still higher. An amazingly steep rally here. Obviously, the crude market still pricing in a little bit of worry. That not so evident, however, if we look at S&P 500 or equity markets in general. We're seeing this huge snapback, really back to the old trend line, as if the Egypt situation that really got traction on Friday, as if it didn't happen. And this is just an incredible comeback, and risk caught us, I think, wrong-footed in some of our analysis. We were going to some key levels and resistance, but those levels were taken out today with a plum. And of course, we've got some heavy event risks later this week, but some key developments in FX today where very interesting lines in the sand were crossed. If we look at Eurodollar to start things off, this retracement level around 137.40 or so, obviously not holding at all today, and the dam really broke once it got up to new highs, even after a very strong U.S. number, and despite relatively favorable U.S. interest rate developments in terms of the spreads, etc. So this is a very weak sign for the dollar, and suggests very much, of course, that even with interest rate spreads going the right direction, it's really risk appetite that is driving the dollar in this dollar and vice versa, and we will not see a stronger dollar unless we see risk coming off. And in fact, if we look over at the ECB rate expectations here in the form of the March 2012 Euribor contract, is back down towards the lows, so the market's still pricing in this 100 bips or so. Well, we're saying 100 bips, 75 bips or so in actuality for the year forward from the ECB. Looking at bonds, we have them to new lows today. Seen with 2020 hindsight, of course, we should have been unimpressed really with the comeback here on this bar. Volatility was really low compared to what we were seeing elsewhere in the reaction to the situation in Egypt, and that should have given us really a heads up on the fact that the pressure was very much to the downside still, at least here short term. So we have bonds trading at new highs for the cycle, going back to this is a contract for only 3 months, so we can't get a yield chart right here, but going back quite a ways, there were some higher levels post global financial crisis, but this is much higher levels in yields. You'd expect that on the one hand to be driving the yen a bit weaker with higher yields, but if we look over the U.S. Fixed income, even though we had a strong ISM report out of the U.S., the dollar is weaker, and U.S. Treasuries bounced quite a bit. So even despite that spread improving a little bit at first at the front end, there's still relatively good support in the bond market. And who cares about bonds and everything else when looking at a chart here, we can see that dollar yen sold off quite heavily. So first we had the big rally on the Japanese S&P 500 downgrade of Japanese government debt, where we did fair enough point out that the actual reaction of bond markets was not verified by what was going on in FX, giving us the impression that the FX market is a bit fickle and not necessarily to be trusted if we don't find confirmation elsewhere. But anyway, then we sold off again on the Friday news out of Egypt, and this Ichimoku resistance held. Now we've got a very big extension here, really fully takes out this local support here now, and of course we're looking at this key trend line going back to the lowest levels here, which were just above 80, and that stretches all the way back to 1995, where the low I think was 79.92. I checked on a chart today. So this momentum, if this keeps up, it looks like we're going to be testing to new all-time lows in dollar yen. I mean, certainly the dollar view very degraded today after what we've seen in the markets. Euro yen, rather interesting. We saw a big sell-off. The acceleration again here higher after the S&P. If I said S&P 500 downgrade, that's just me not thinking. The S&P ratings agency's downgrade of Japanese debt. And then, of course, the Friday sell-off. But notice that the recovery in euro yen has been a lot less robust than what we're seeing in risk markets, etc. So you would think that if there's some chance for the ECB to come out with something that's a bit bearish on the spreads and interest rates, Trichet underlines that he's not interested in raising rates anytime soon, what have you, maybe that could be expressed in a euro-yen slide continued. Certainly no argument for that right now, as interest spreads stand at the very moment, but something to watch out for if indeed ECB comes out and tries to really throw a wet towel over expectations for interest rates, which one would think they would want to do considering where they've already accelerated to. Looking at other crosses, and I forgot actually, let me go back here. Australian dollar, a very key level here. Also 2020 hindsight, I think we said it a few days back. This congestion area was going on for so long that the time signal was, or on the time horizon, or the factor of time being included in the equation would kind of suggest that the momentum was fading out already even back here, but then this stretched on for a few days, and we got tempted by the return to the lower end of the range after the Egyptian situation, etc. And now we've broken back above this really key Fibbo level. Leads you to believe that it's going to head quite a bit higher. And here's a kind of line actually I don't like to draw, but that would suggest 103. I think 104, 105 is in the cards if we see equities continuing to post new highs. And actually a very similar situation. Here we had a major high around 92 or slightly above. Had a nice retracement, probably about a 6.8 retracement there. And then a retest a little bit higher. And then this key huge bar sort of really rejecting the risk of a downside market continuing. And that volatility, that really strong momentum bar leading to much stronger gains. I'd be, of course, surprised to see the degree of gains this time around. But you've got an awfully big bar here to deal with on the upside, and it's going to take an equally negative bar to wipe away anything but short-term bullishness from this point on. Looking at cable as well, today with a very strong PMI out of the UK. We also had this NIESR, which is some influential research, something or other economic. I don't have the abbreviation for the acronym, but it's relatively influential. They do GDP estimates, etc., policy recommendations, and they were out saying that the UK, the government should be toning down on the austerity and toning up on the rate hikes. Interesting approach. Anyway, with the strong PMI today, the forward expectations moving into overdrive for the UK, for the Bank of England, we saw a move of 15 bips today. That's quite a big move, and this is being expressed in FX with a strong break higher. And if we take this out on a longer term, we sent this out on Twitter earlier, longer term basis, here on the weekly, you've got quite an interesting sloping upside down head and shoulders formation with a shoulder here completing the right shoulder. And then one might think that we could see the 200-week moving average coming into view. Again, this is against all of our longer term expectations, etc. This is purely expressed from a technical point of view, but we do have to change our views if when we get a day like today, which really does cross some lines in the sand, and is going to lead to reformulation of what we're thinking going forward. We would like to see the end of the week, but this is a rather interesting day. Dollar Canada, moving on. If you don't know what an evening star formation is, this is a textbook case, very high volatility move upwards with Egypt, etc. Friday, uncertainty, a doji star, tested the 55-day, and then a dramatic down day today. It really is going to require quite an up bar to reject that formation, and it leads you to believe that we're going to get back towards the old downtrend, moving, grinding, possibly lower to 98, 97.50, what have you. Looking at dollar Swiss, we did see a comeback day yesterday, led us to believe that maybe this was some confirming development, momentum-wise, otherwise, on the situation for dollar Swiss, looking for a trend change after this old low failed to hold here. But now, of course, momentum is declining again, or picking up to the downside, if you will, and that sets up a worry that we test lower once again, possibly even to that old low, going back to the days before the financial crisis. Of course, those lows have been surpassed. So these are the lows for dollar Swiss, and those are the lows we could be looking at here locally now as well. On the emerging market front, we still saw worry in emerging markets almost across the board, in certain cases anyway. Well, you can't have across the board and in certain cases, but if we take the South African rand, it's been performing very poorly lately. An interesting bounce off the 200-day moving average today, and showing that even the likes of the South African rand finding some support today. So really strong risk appetite across the board. We'll need to see some worrying new developments in the Middle East, elsewhere, and real signs of risk aversion if we want to get this dollar view to turn around. So heading into tomorrow with the ECB and into Friday with the U.S. Unemployment report. Also keep in mind tomorrow we have, not tomorrow, but Thursday we have the U.S. ISM non-manufacturing. That's a critical one as well. The employment, the reading on the last time around was not so good. We'll see what it is this time. In any case, a very interesting day in markets, very key day, and keep on your toes and realize that we've crossed some lines in the sand, so those need to be recrossed if we want to believe that they're not going to continue going down the road here. With that, over and out.